Hello everyone. Today we will discuss the bank reconciliation statement. So the meaning for bank reconciliation statement is a statement which is prepared to reconcile the difference between the bank balance as per the cash book and the bank balance as per the passbook. So here we are going to discuss about the banking transactions. So the banking transactions will be recorded in two books. One is passbook and then one is cash book. So whenever we are having the transaction, there are some miscommunications and some errors will happen. So sometimes in passbook, automatically the banks they will enter, and cash book, the manufacturer or businessman, they will not enter until the cash realized. Right? For example, any depositing the cash in the bank, immediately we will enter in our cash book. But in bank passbooks, once they get the amount, when the check is realized, then only they will be enter the transactions, so it will get take some times, right? So this is what we are going to discuss here. What are the types of errors will happen and how we can rectify these kind of errors. So we'll see the definitions according to J.R. Batley Boy. A bank reconciliation statement is prepared at periodical intervals with a view to indicate the items which cause disagreement between the balance as per the bank column of the cash book and passbook balance on any given date. So the features of BRS, the important features of bank and reconciliation statements are: it is a statement and not a ledger account. So here we don't create any ledger accounts. So we are going to discuss about the statements. So it is prepared periodically, say weekly or fortnightly or monthly, quarterly or half yearly or yearly, depending upon the volume of banking transactions. Right. So generally it is prepared at the end of every month, and it is prepared by the bank customers. So they are the businessman and not by the banker. It is not a part of books of accounts. It is prepared on a sheet of paper outside the books of accounts. It is prepared only when there is a difference between the cash book balance and the passbook balance. It is prepared to verify the accuracy of entries made in the cash book and in the passbook. So we will prepare the BRS whenever you are getting the differentiated value in passbook and cash book. Right? So easily you can understand there are some errors or omissions or mistakes. So you need to identify the differentiated values by using the bank reconciliation statements. Now, what is the need of BRS? So both the cash book and passbook contain the same banking transaction. So the bank balance as per cash book and the bank balance as per passbook should agree on any particular date. However, in actual practice, the cash book balance and the passbook balance do not tally. Hence, ascertain the causes of difference first and then reflect them in a statement called bank reconciliation statement. To reconcile, it means that tally the two balances. Now we will discuss the reason for the difference between cash book balance and passbook balance. So the difference between the cash book balance and bank passbook balance is caused by timing differences on recording of the transactions. So each transactions will take different times to record the transactions. That's why the differentiated values we are getting, and one we are getting the details and other books we are not getting the details. And second reason or second differentiation will be the errors made by the business or by the bank. So let me discuss detailed in what are the issues we will face in timing differences. So when a business compares the bank balance of its cash book with the balance shown by the bank passbook, there is often a difference which is caused by the time gap in recording the transaction relating either to payment or receipts. So there are some factors which affect the time gap, like checks issued but not yet presented for payments. Right? For example, now as a manufacturer or a businessman, you are issuing the check to your seller or any other agency. So you will enter the amount in your cash book because already you are issued the checks. but the seller, they will not present the check to the bank for realizing the cash. So because they are having more time to present the check, so they will present the check after 2 weeks or 1 month, right? So up to 1 year, 1 month, the amount is not debited in your account until the seller or the agency is going to present the check in the bank. Once presented the check in the bank, then only the amount will be debited from your account. So up to 1 month, the transactions difference will be there in your cash book as well as in your passbook. Right? And check deposit into the bank for collection but not yet collected. Now you are depositing your check. Right? You will receive the check from your customers instead of cash payments. So you are depositing the check into the bank and you are updating the transaction details you are entering into your cash book, because already you receive the check and you deposit into the bank. But the bank will take time for collecting the money or to realize the amount when it becomes the outstanding states. And direct debits made by the bank, sometimes they will charge interest. So direct debits the bank they will make, you will not know that, you will not check the messages and transaction details, so you will not enter into a cash book, but it will be updated in the passbook by bank sites. So amounts directly deposited into the bank account by third parties. So sometimes customers directly they will deposit the amount directly to your bank account. Nowadays we are having the Google Pay and also online payment. Whenever you are making directly, it will be credited to in your account, but you will not enter in your cash book. So there will be the differentiation. And interest and dividends collected by the bank, then direct payments made by the bank on behalf of the businessman, then checks deposited or bills discounted. So all these transactions will take the time difference between cash book and passbook. That's why we are getting the differentiated values. And differences caused by errors. Sometimes the difference between the cash book balance and the passbook balance may arise due to an error made by the bank or the business in its books. So examples of such errors are wrong debit or wrong credit, under casting, over casting, etc. So errors made by the business in the cash book or errors made by the bank in the passbooks. Right? So the errors we are having in different types. So errors will be made by the bankers or the business peoples. Right? So it will also cause for the differentiated values. So rectification of errors. So errors in accounting meaning unintentional mistakes committed by the bookkeepers in the books of accounts. So errors means there is no intention to make the mistakes by the bookkeeper. So unknowingly, by default or by any reasons, they forget or wrongly they will debit or credit the values. So it will affect both passbook's values and cash book values. So we are having different types of errors. So errors in accounting can be classified in two bases: on the basis of the nature of the errors and on the basis of the effect on the agreement of the trial balance. So on the basis of the nature of the errors, we are having different methods. One is for error of principle. So errors of principle, it means the accounting entries are recorded as per the generally accepted accounting principles. So we are following the GAAP principles. If any of these principles are violated or ignored, then errors resulting from such violation. So for example, old furniture sold for rupees 10,000. So old furniture means it's a capital assets. If you are considering this as a sales, then you will not follow the generally accepted accounting principle. So when you make the journal entry, how you will make? So the correct entry will be cash account data to furniture accounts, because it's a capital receipt. But the wrong entry, what we will make? So cash account data to sales, because you are selling the furniture. Right? So when your business is related to furniture sales, then it will become a sales to sales account. But your business is belongs to other category and you are having some old furniture, so it is a capital asset for you, and then now it's not required by you are selling that. So it's not a revenue receipt, it's a capital receipt, right? So this is how we need to change by right. So This is what the principles of errors. And the second one is error of omission. If the transaction is completely not recorded, either at the time of recording the transaction in the book of original entry or while posting to the ledger, such errors are termed as errors of omission. So example, a credit purchase of goods from Madan rupees 15,000 has not all been recorded in the books of accounts. Then errors of commission. An error of commission refers to an error due to some clerical mistakes. Error of commission take place when some transactions are incorrectly recorded in the books of account. So a few examples of the transactions are recording a wrong amount in the subsidiary book, then posting twice or twice to an account, on wrong totaling of a ledger, wrong carry forward. Then compensating error. Compensating errors are errors which compensate or neutralize the effect of each other. For example, if purchase book is under cash by rupees 2000 and the sales book is under cash by rupees 2000. If rent account is overcast by rupees 500 and wages account is undercast by rupees 500. So this is how the compensating errors will work. So if you made any mistakes, it will be compensated with the other entries. The second major differentiation on the basis of the effect on the agreement of trial balance. So it's one-sided errors or errors disclosed by the trial balance. One-sided error refers to an error which affects only one aspect, namely either debit aspect or credit aspect of a transactions. So examples, posting a wrong amount to the wrong side of the correct ledger account. And second one is a two-sided errors or errors not disclosed by the trial balance. A two-sided errors refers to an error which affects the aspects like debit aspect as well as credit aspect of the transactions. Now the rectification of errors means correction of mistakes found in the books of accounts. Now we have seen how the errors will happen and what are the types of errors are there. Now we can go and discuss how we can resolve these issues by applying the methods. So bank reconciliation statement and rectification of errors, we are following the format. Right? So both the format we can use. The first format, first we will start with the bank balance as per cash book or bank overdraft as per passbook. Then we need to add the total of transactions increasing the cash book balance. And from this total, we are going to minus the total of transactions decreasing the cash book balance. And then the balance amount we will get, that will be called as a bank balance as per passbook or bank overdraft as per cash book. So this is the one format, or else we can use this alternative format also. So bank balance as per passbook or bank overdraft as per cash book plus total of transactions decreasing cash book balance. With the outstanding balance, we need to minus the total of transactions increasing cash book balance as per cash book or bank overdraft. As this will be the total values. Now, these are the transactions affecting cash book balance. Right? So the transactions increasing cash book balance, and these are the credit side transactions decreasing cash book balance. Right? So first we will see the transactions increasing cash book balance. One is check issued but not cashed, and direct payment into bank account by a third party entered in the passbook but not entered in cash book. Then overcasting of credit side of the cash book and wrong credit in the passbook. Then interest on bank balance credited in passbook only. And these are the transactions decreasing cash book balance. One is checks deposited into bank for collection but not collected, and check received from third person entered in cash book but not deposited into the bank. And overcasting of debit side of the cash book, then wrong debit in the passbook, bank charges and interest on overdraft debited in passbook not entered in cash book. And this is also the same how these transactions will increase the cash book and a few transactions are decreasing the cash book. So hope you understand these concepts, and next class we will discuss with the problems. Thank you.